Finance can be messy, but don't worry. We clean it up with facts, fun, and maybe a little sarcasm. Welcome to the Financial Sandbox. Let's get into it. Today, my guests are Beth Good and Brian Sone from Resource Royalty. Beth is the CEO, and Brian is our head honcho that's out there lassoing advisors like myself to bring in money to the offering.
That's right.
So, Brian, why did you choose that role, and how long you been doing it?
Yeah, so I've been in Resource Royalty since 2019. Prior to that, I was at Bank of America Merrill Lynch, focused on the alternative investment side. Kind of looked at the entire industry, said, I'm not somebody that's going to go out and model things. That's kind of not my expertise, but I love talking with advisors. I love raising capital, understanding a deal from the inside out, and then going out and executing on the capital raise side. So came to Resource Royalty in 2019, became a partner earlier this year, and then I cover the entire country. So, I work with guys like you out in the Bay Area, all the way to people in New York City, and then everywhere in between.
Nice. It makes quite the travel season for a guy who's got a new baby, but we'll get into that later.
No doubt. I was in Tampa just yesterday.
So you're in the 1031 exchange space, and this is where some of your money comes from. This is your investment. That's where I work, in the Delaware Statutory Trust space. Beth, it's not a DST. You're an LLC. Why does this fit with investors who are doing a 1031 exchange?
First of all, Herb, how are you? Thank you for having us on the show. It's nice to be here. So you're correct. We are not a DST structure, and we're actually not an LLC. The LLC entity acquires mineral properties, and then that LLC entity sells those mineral properties to the investor. So at the end of the offering, the investor actually owns deeded real estate in mineral properties, which is subsurface real estate. And for those people that are not aware of the fact, in the United States, you've got 3 estates of real property. Of the air estate, think New York City. You've got the surface estate, that's what your home sits on. And in this particular case, you've got the subsurface estate, that's the mineral properties. And those mineral properties can be used in 1031 exchange. So if somebody's coming out of bricks and mortar, they can invest in subsurface real estate.
Thank you for correcting me there on how the entity is structured. Can you talk about, not everybody knows what minerals, what does that mean? And what are the wide variety of minerals that are out there?
Sure. I'll take that, Brian. So when we talk about mineral properties, we use the term mineral interest, mineral properties, royalties, and we use those interchangeably. So think of the Clampetts on Beverly Hillbillies back in the day. Somebody would stick, put a stick in the ground, look for oil. And when that oil comes up, whoever owns that dirt, that subsurface real estate, they're going to earn royalty income on that. In our particular case, another company, an operator, is drilling the well on there. They're drilling it on that subsurface real estate. And so the investors that own that subsurface real estate, they will get to enjoy royalty income. Same thing applies if it's a gold mine, silver mine, fill in the blank. It's the same concept.
Right. And you guys have been launching offerings in this space since 2010, is it?
2010, we started with a limited partnership structure. And about 2014, 2015, we changed to this 1031 centric focused offering structure. And we are currently on Resource Royalty 25, about to launch Resource Royalty 26.
Wow.
Yeah.
Wow. So where does, when people look at a outline of your offering, where are they buying? Where are these minerals that they're buying and their income coming from?
Sure. So since inception, we have bought in all of the major basins. As time has progressed and prices have fluctuated with regard to acquiring the mineral properties, we've been very focused the last several years on the Mid-Con, the Anadarko Basin. You'll hear those terms used interchangeably, and basically it's Oklahoma. There's a swath that goes northwest to southeast, and that's the Anadarko Basin. So the
okay.
are located there, but we also look at Texas for some additional properties to put in the portfolio.
So to either of you, when you started this and said, we're going to offer this in the 1031 exchange space, what were you trying to solve for investors when you first launched? What was the impetus?
Brian, you want to?
Yeah, so I'll jump in here. And I think that impetus has changed since 2011 as you kind of look at not only the cycles that we've had in oil and gas sector, but also the cycles we've seen in real estate. And so, what we were originally solving for can change in what we're solving for in 2025. And so looking through the lens of, let's go back 5 years. Before we had cap rate compression in real estate, say things were yielding 7, 8, 9% on multifamily or whatever it was. I wasn't as pretty girl as the bar as we are now, right? A lot of people said, hey, I don't necessarily want to take that commodity risk when I can get that same yield over in real estate. And that's to be fair. At the time, I think a lot of people used us in 2020 and 2021 to have diversification. Or if somebody said, hey, I really like the structure. I like 1031 exchange eligible. I like that there's DSTs. Maybe I can pair my offering with DSTs, and I can also have something where I can exercise that full control. Because if my offering, let's say right now, is made up of 20 properties, the investor is going to own a deed and a title to all 20 properties. I've got a 5 to 7 year time horizon, at which point our goal is a liquidity event. But if for whatever reason they need to in year 4 and they call you and they say, hey, Herb, I have got to exit this portfolio. Now, we don't recommend that or an early exit, but they have that full autonomy to do that. So they can say, I can take the DSTs and then maybe I can have something where I've exercised a little bit more control. On the flip side, in 5 to 7 years, when we call and we say, hey, it's time for a liquidity event, we might have people that say, you know what, I'm going to go ahead and retain this, continue to have resource royalty manage it, maybe put it into a trust and allow my heirs to have this. It's just mailbox money in the future. And so as you've seen kind of that real estate market shift, and some of those things are yielding 4, 5, 5.5%, I think now our focus is saying, well, if you're trying to achieve maybe a yield of 7 to 8, there might make sense for it to take a small portion of your overall exchange, allocate that to mineral rights, and now we can get that blended yield higher than what you could have gotten with just commercial real estate alone, right? We're still solving that diversification piece, still allowing that direct title autonomy that they have that I talked about earlier. But now we're being a little bit more yield focused. And of course, you're going to have that commodity risk associated with our offering that you want with commercial real estate. But that also is on the upside too, right?
Right.
So I model something at historical pricing, it's say $60 a barrel. If we do go to 70, 75, 80, and we do see that increase above what our target distribution rate is, then the investors are rewarded on that upside as well. And so I think that's kind of where we see a lot of people like you and across the country are utilizing us now, is get that blended yield up and still offer the other things that we've historically done.
Now, I try to keep this conversation simple, trying to do an explanation to a 9-year-old, right? So I don't want to go too deep, but one of the things, when you have a traditional DST, most of the income from that offering is monthly, and it's an automatic deposit into the investor's bank account. You guys are quarterly, right? And how does that income, how does it calculate if the quarter ends December 31st? Where's their income coming from? Is it just from Q4? Is it coming from Q3? How is that calculated?
Well, if we want to make this simple, then they're going to receive a quarterly distribution. It's always the month following the end of the quarter. So Q4 ends December 31st. Our distribution is going to go out at the end of January. Q1 ends in March. Our distribution is going to go out at the end of April, and so on, July, October, through the rest of the year. And the reason that we do that quarterly is really to facilitate the fact that when we make our portfolio, we've got all these wells on all the different properties, right? Those wells are extracting oil, natural gas, and natural gas liquids. That operator is going to send our investors a royalty payment, which is a portion of the overall revenue. Well, a lot of times I'm going to have, and our investment strategy is to have new wells come on. As those new wells are drilled and they begin to produce those hydrocarbons, we receive that income. We want to be able to reconcile all that income with our financial reporting department and then send them that brand new well in addition with all the other wells that are being paid. And so from our standpoint, we look at this and we think that quarterly makes the most sense. And so when we're sending that to the investors, not only are they going to receive the money ACH'd into their account, they're also going to receive a paper copy of a market update letter and an entire update of what they own. And I like to call it, Herb, that, if they go to a dinner party and somebody says, hey, I heard you did a 1031 exchange with Herb Alston and you used mineral rights, right? What is it that you own? Well, if they take a look at my quarterly investor update letter, they should say, what is it that I own? What commodity price was I just paid on? What new activity is taking place? And then what should I expect going forward? And so all of that information that we understand is opaque if you don't, live in Dallas, Texas or Houston and you're not in the oil and gas industry. So we really want to make that, like you said earlier, simple to digest, that a child could look at that and say, look, I understand. I was just paid on $65 oil. Here's the new wells that are in pay. Here is my distribution rate. Macro picture, what's taking place that might come down the pike later on this year and in subsequent years and affect my distribution rate.
Sure. Absolutely. So you've been talking about wells coming online. You guys aren't wildcatting. This is established offering, right? These are established and running wells. I mean, I look at it sometimes as I'm the landlord and XYZ oil company is my tenant. Would that be accurate?
Yeah, I think that's a fair statement. Ultimately, what we're trying to do is our investment strategy across every offering is going to be the same. That's going to be current income, development, and principal preservation. And so in order for me to have current income, each one of these properties, I want to have those wells, which are effectively our partners in this offering, right? We've bought the property. The wells are going to be on top. They're going to be extracting the oil and gas that our investors own and then sending us a portion of that revenue. And then we want to have the development of new wells through the life of the offering in order to have that principal preservation goal on the back end.
Right.
And Herb, I'm going to
go ahead, please.
Just add to what you've said, just to clarify, because people hear oil and gas and the first thing they think is that this is some kind of a drilling deal.
Yeah.
We do not drill in these 1031 portfolios. We rely on publicly traded operators. I can throw out some names: Devon, Chevron, Oventive, that kind of thing. They are the companies that are actually drilling the wells on our mineral property. So no, we do not wildcat. We rely on established, deep-pocketed operators.
Right. Great. So it leads me to defining the characteristics of the classic resource royalty offering 5-10 years ago. How does it compare to what you're doing today? Or is it the same?
I think one thing that any successful investment management company is going to do is they're going to change their strategy based on market conditions, right? What you were doing in 2005 or 2010, probably if you're in certain asset classes, isn't the same thing you're doing in 2025. And that doesn't mean that it's a drastic difference. It just means I'm going to shift my strategy to be conditional to whatever the market is. And so if we go back to, 10 plus years ago, we had a little bit more of a development focus. Well, that was at a time when there's about 1,100 rigs running in the continent of the United States. As that rig count has gone down, I want to de-risk my development section of my investment strategy. And so what we've done by de-risking that is you're going to see our offerings are $10 million and below. They're going to be large acreage positions on each one of these properties. We're going to have a whole swath of currently producing wells. And then we want to just model for several new wells per year. And in addition to that, we're going to buy properties with wells in various stages of completion. Because our whole goal here is it's almost like a mutual fund, right? You've got the ability to buy into a bunch of different properties and a bunch of different producing wells. And, the average investor isn't going to say, well, they could go do what we do. They can hire a landman, hire a title attorney, hire an engineer, hire a geologist, and they can go out and they can buy a $9.7 million offering. But here at $100,000 investment, you still have the exposure to all the same properties and wells as somebody that comes in at a $5 million investment. And so what our whole goal here is, because we know that, to your term earlier, we're not wildcatting. We're not trying to take a gamble. I'm not hoping that we're going to have, these sky high prices in order to hit our expected distribution rates. Rather, what we want to do is de-risk the elements that we can, given the current market conditions. And so what we've seen is a less focus on drilling taking place in the continental United States. And so since we've seen that since kind of 2020, 2021 time, as interest rates ticked up, we want to de-risk that portion. And so we're having a less emphasis on new wells being drilled and more buying those properties with the wells already in completion, various stage of completion, already producing, and then the ability to have that on the end goal.
Right.
And I'll add one more comment. A lot of this was driven by the fact that late 2018, Wall Street came and said, operators, we want you guys to change the way you're doing business. We want you to clean up your balance sheet. We want you to start paying off your debt. We want to have more, or see more free cash flow. We want you to have better dividends, and we want you to start buying back your own stock. That took place really in 2019. And at that point, that's when the rig count, we saw that start to decline. And then, 2020 hit with the pandemic and it really fell off the cliff, but it's come back. But point being, the operators have become much more disciplined with regard to the pace of drilling new wells. So when we put together a portfolio, we are very, very focused on being conservative, like Brian said, with our price deck, our underwriting, and then with our pace of drilling of any new wells.
Gosh, you've confused and brought me into chaos on 4 questions I had. So I'm gonna try to throw them all out there. When did 1031 exchanges become a meaningful part of your company strategy? Was it about that time that prompted that shift, that 2018-19 timeframe?
It was part of that. 2014, really. 2014, I think, was our first one.
Oh, okay.
Yeah.
Okay. So you work with the accredited investors and private institutions. That's mainly your client base. How has your client base evolved over time, and what kind of investors are you primarily serving today?
I think our investors range the gamut from Bob and Lisa in Cincinnati that owned, a single family home that they were using as an investment purpose. And they said, hey, we want to use you, as I said earlier, for that specific thing that Resource Royalty and the mineral rights can do for my overall exchange, all the way to the investor maybe that's in La Jolla that says, hey, I've got $200 million worth of investment properties, ranging the gamut from multifamily to single family homes to strip centers. And, I think, so we have all types of investors. We have all ages of investors, all different walks of life. But the most important thing, and one thing that I think, Herb, you and I have been working together for a long time, that is not just that we have all these sort of people under the broad umbrella of Resource Royalty Investor, but the right investor, right? Because it doesn't make sense for grandma that's 85 years old that needs $3,000 every single month to pay her mortgage to come into an investment that has commodity risk. And
Correct.
We're the first people that preach diversification. We want to preach that we want the right people. And at the same time, if you're going to look at, Bloomberg, or you're going to look at CNBC every day and you're going to say, oh, it's $75 oil, my check is going to be huge. Oh my gosh, it's $55 oil, it's going to be nothing. That's probably not the right person as well, because we saw the strategic point in the overall allocation. We're just one of many different things that investment advisors like you have access to. And so what we like to do is, throughout the course of when I first work with somebody, we get on a call, and maybe you can talk about this a little bit too, Herb, is we like to go through, who are we? What do we do? How do we do it? What's the underwriting look like? And then what's the end goal? And I think if we can paint that clear picture about where we're trying to go, then we can have somebody that comes in and says, hey, I get it. I get that I own subsurface real estate. I get it that there's publicly traded companies and large private operators which are drilling on my property, extracting my oil and gas and paying me. I'm getting these quarterly distributions. I'm getting these deliverables explaining what it is. And then I get where Resource Royalty is trying to take this. so that later on in the future, I can do another 1031 exchange. Because, the whole point here is, how can I defer those capital gains, get maybe a larger expected distribution rate than I can get in commercial real estate, and then be able to go back and do that again in the future. And so,
that's one of the ways I use it as well. A lot of times, because you're working with multifamily that might have a yield, a cash flow somewhere between 4.25 to 4.75. And I'll say to a client, let's take part of your exchange. And are you open to putting it into oil and gas? Let's have a conversation with Resource Royalty and talk about their offering. And yes, their yield's different, but where is the risk? We look at what's oil today in the high 50s. How much should that investor worry about the fluctuation in the market? Or are you guys already set in it's kind of steady eddy?
Yeah. So, our income is going to be lumpy. I always like to say, again, back to that grandma that's 85 years old, if she needs that exact fixed dollar amount every single month in order to pay her mortgage, let's go with real estate, right? Let's go with something else. We'll be the first people to say that. Again, we're trying to solve a problem here, maybe get that blended yield higher. But ultimately, what we're going to do, and the way that we model and our engineering is going to be for each offering, is we're going to take whatever the NYMEX futures, so the New York Mercantile Exchange, and we're going to say, what is the currently trading price? And then we're going to discount that for our offering. So we're going to say, what's going to be our base case modeling? So let's use an example. In 2026, let's say I need $65 oil, maybe $3 natural gas, whatever the equivalent natural gas liquids pricing is, and then I'll have my expected distribution rate. We're going to run a mid case showing you that, hey, if it's lower, that distribution rate will be lower. Now, in addition to those commodity prices, we're going to want those new wells that we have modeled for to come online. So the risk is going to be, much like a lot of people would understand, is commodity risk and then the timing of new wells.
Sure.
But in that same sense, when we're looking at this, when you're going to have every single minute of every hour a different commodity price, we like to look at everything from an annualized basis. So it's almost review mirror looking behind me, right? We're saying, hey, at the end of the year, if this was the average oil price, this was the average natural gas and natural gas liquids price, then we can achieve these expected distribution rates. And again, I think since 2011, one thing to hang our hat on is we've never missed a distribution and we've never suspended distributions. We've had them be during COVID, as you can understand. They were not pretty, right, when oil's trading at $22 a barrel. But there's never been a time where we've had to go to the investors and say, hey, there's coming nothing, right? Because as long as oil and gas are extracted from these properties, their investor, by law, is going to receive a portion of that revenue. And so I think when we're talking about, kind of where those risks lies, is it's back to saying, if you can understand that we've got a base modeling and these are the prices that we want to see. If it's going to be higher, the distribution rate will be higher. If it's lower, it's going to be lower. But here's where we generally want to see these prices for this particular portfolio. And if the market shifts, if we get into a higher commodity price environment, my next portfolio 6 months down the road might have different underwriting. Transversely, if it goes down, then we'll have the different one. So it really depends on when did I buy these assets, what was the commodity price look like, and then what is my forward expectations.
Right. So Beth, with more than a decade of offerings behind you, what's one or two key lessons you've learned about building royalty portfolios and that can deliver durable, risk-adjusted income for investors? What have you learned?
I'm going to go back and use the word discipline. Just be as conservative as we can with regard to our underwriting commodity price, just in the example that Brian was talking about just a minute ago. And then the pace of drilling, because I always tell potential investors, there are two things that we cannot control. And it's the commodity price and when that new well is going to be drilled. So if we are putting together a portfolio and we all of a sudden come out of the gate saying, hey, we think there's going to be 20, 30 new wells next year. Historically, that has not proven out, and we're not going to put together a portfolio. Right now, we're using 4, maybe 5 new wells a year, which is ultra conservative. And like Brian said, we'll take the current NYMEX price and we'll discount that when we're putting together the properties.
So There are a number of mineral and royalty operators in the market today, a few in the 1031 exchange space. From your perspective, what aspects of resource royalties, history, sourcing, management approach, what differentiates you from your peers?
I'll answer that. The one overriding comment slash feedback that we just consistently get is the responsiveness of our investor relations team. You send me an email with a question, we're going to get back to you probably the same day, and if not the same day, definitely tomorrow. Our information is accurate, because the last thing we want to do is provide tax documents at the end of the year and have to come back and say, oh, we made a mistake, your tax return's wrong. So we really take pride in being very detail oriented and very responsive.
What do you see like 5 to 10 years? Maybe we shouldn't go 10 years, maybe just 5. Oil and gas space, what do you see as the biggest opportunities, the biggest risks?
I think I can touch on that. Is what we're seeing is our ability to look at market conditions based upon our also partnerships that we have with various groups, and I think source what we believe are going to be the best assets that we can put into a portfolio. So, earlier you kind of asked, like, where are we focused? And, we've been historically focused on that mid-con. We'll add some Permian to each one of our portfolios, but we've had portfolios in the past that have had Colorado, that have had Pennsylvania, that have had the Dakotas. And it really depends, because what we like to say is we're open to anything. It really comes down to when we model it, when we have our geologists look at it and we have our engineer look at it, is this something that we can go and put the resource royalty stamp on?
Sure.
And so from that standpoint is, in the future, perhaps there's another play that we say, hey, this can reward our investors. We're seeing that these are going to be great assets. We can put this into a portfolio, because what we were doing, like we had talked about earlier, 5-6 years ago, isn't exactly what we're doing today. And so the ability to be nimble, to look at market conditions and say, how can we always be best and be better and continue to move the ball forward so we can provide to our investors something that is going to accomplish all of their goals and be able to have the best distribution rates that we believe that we can have at those risk-adjusted pricing models.
That's probably a different question for you as CEO, Beth. What do you see as the big opportunities and the big risks down the road? Or are you in alignment with Brian?
Yeah, I completely agree with Brian. I think opportunity-wise, I think it's going to be interesting to see what the oil and gas business does, not at the mineral level, but more with the operators. I mean, I always use the example, I will get an email at 10 o'clock in the morning, and it'll be from one of the agencies that oversees the supply of oil and natural gas, or the price expectation over the next 30 days. And it will say, we've got a supply glut, we think the price is going to go down. At 10 minutes later, I will get another email from another group that says exactly the opposite. Nothing's happened in that 10 minutes. There have been no world wars broken out, no supply, pipelines bombed, or nothing. Nothing's happened. It's just different viewpoints. So I think the opportunity there is a lot of people are waiting for the prices to stabilize. I mean, we've got geopolitical factors. We've got tariffs, again, fill in the blank. There's so many different things affecting the commodity price. I think if we can just see some stabilization in this market, I think there's great opportunity ahead.
Right. Beth, your career started in the Big Four accounting, right?
Yes, except that I'm old enough to say there were 8 at the time.
There were 8.
Yes. I've been around a while, Herb, but thank you.
Then you moved into private equity and fund management before joining Resource Royalty in 2012, right?
Correct.
What was the key pivot moment for you that pulled you into minerals and royalties? What attracted you?
So the 2 gentlemen that started the firm were actually neighborhood friends. All of our kids were the same age, and so I'd known them for a long time and had deep respect for their business acumen and for their judgment and just their honesty. And because this is an interesting market, and a lot of times oil and gas people get branded with, hey, I'm not going to do an oil and gas deal. I heard about my friend that lost all his money. So if I'm going to put my name on something, I want to be with a group that will allow me to sleep at night. So, and this was the group that would do that. And then just coincidentally, the other thing that I always tie this back to is in late 1929, early 1930s, the United States was in the middle of the Depression, right? There was a little pocket in deep East Texas where my mother's family's from. That was the oil boom. It was huge. I've got pictures where there are oil rigs. They're the spacing, they're almost touching one another. And so at that point in time, my family started buying minerals. So we've had minerals in our family since the 30s. So I do have a deep understanding of owning mineral properties. My grandmother told me never sell them, which was one of the stumbling blocks when I started here, because I kept saying, but nobody's going to be selling them. They said, oh, no, Beth, it's different in 2010 than it was in 1930. So there's a market, and we will be able to buy some. So here I am today.
You were recognized and have been recognized as a woman of influence in the Dallas business circles. How would you describe your leadership style at Resource Royalty? At Concord, where my licenses are, I have a female CEO. You're in that female CEO role. What would you tell young women who look at you as a leader and as a mentor? What would you tell them? And second question, what would you tell that 12-year-old Beth Good?
Well, I want to go back a little bit farther again. So, people always ask me, why are you in business? Why are you not doing something else that maybe would have been a more traditional female role? And growing up, I was the kid that when everybody came over to my house, we played office. I had a little TV tray. I would make people, answer the phone and take notes. So I've always had that kind of office. This is what I wanted to do. 12-year-old Beth. I don't know that I would have anticipated being in this role at this time, but probably my greatest influence on my career would have been my grandfather. He was a very strong leader, had many different businesses throughout his career. And so I really learned a lot from him. And he had a saying, and it was, if you know not your diamonds, know your jeweler. And it took me a long time, because I would see that as a child. And it took me a long time to finally understand it. But to me, it just always meant, say what you mean what you say, and work with integrity. And I don't care if you're being a spokesperson for Resource Royalty, or if I am being a manager at Resource Royalty. I want people to look at me and say, you know what? She's got integrity and we can rely on her. She's got our back. So
it's the way I always look at you. So
thank you, Herb.
Brian, you have a new baby. How has that changed? Is he getting into the office every day on time, Beth?
Absolutely. Absolutely. Now, he only lives about 5 minutes away, so there's that too.
No, it's been great. Thanks, Herb, for asking. Yeah, I've got almost a 9-month-old baby girl, and we're rocking along. She always needs milk, so I got to go out there and sling minerals. Talk to guys like you. Got plenty of room in this offering. So it's been good, and we're enjoying every single minute of it. Had a fun Halloween. We dressed her up as a bottle of milk.
So questions to both of you. When you're thinking about wells, acreage distributions, what do you like to do outside of the work? How do you recharge? Because this is all encompassing, and your device is probably always telling you a different price of oil, and someone's telling you one thing at 10:10 and another thing at 10:30. How do you recharge?
Or at 3 a.m. You can check commodity prices at 3 a.m. It's not unusual for Brian and I to text at 6 a.m. and saying, did you see the price of oil or the price of natural gas? Recharge, play golf. Play as much as I can. Lots of fresh air, lots of sunshine, and you can spank the ball if you got a little aggression going on.
Nice. Yeah. Do you have a handicap?
Golf. I have shoes. I have clubs, Herb. I have a good time. That's my goal.
What about you, Brian?
I enjoy reading. I enjoy working out. I think that I'm always trying to read a new book, if not like 2 or 3 different books. And so right now I'm reading a book by H.W. Brands about Roosevelt and Charles Lindbergh. And I actually, on a whim, he's kind of a big professor, and I emailed him. He's at the University of Texas, And I said, hey, are you ever in Dallas, or do you ever do any talks or anything like that? And he said, well, I don't, but if you want to come to one of my classes, you're more than welcome. So might head down to Austin, wrap it up with a little work here in a couple of weeks, and go check out like a history class.
That's great. So I'm going to wrap this up. I usually include a couple of animated questions. I'm a big cartoon person, so I'm going to let you think about that for a minute here. But Beth, as you see the growth of Resource Royalty, how do you stay consistent in this market? How do you grow the company? Are you bringing on any more Brians?
I have no immediate plans to bring on a Brian, but my goal is to continue to grow and get to a point where I do need another Brian. But we're going to do it again. We're going to do it with discipline, and we're going to do it and be conservative. So
nice. Okay, now that you're a dad, who do you see as your cartoon hero, cartoon character that you love that expresses Brian today as Brian the dad?
I don't know. I would need a little bit more time. You should have sent me these questions in advance. That's too good of one. But I will say this, I think that when you've got the oil and gas industry, and when you've got largely, the 1031 market and what you do and what I do, there's so many things that we can control, and there's so many things that we can't control. So probably one of my heroes that I always look to is Churchill. Just his steadfast resolve when they were invading England, Nazi Germany was at the time, his ability to lead the country through World War II, and how he basically said multiple times, we're just not going to give up. We're going to defend this island till we're the last man. And so, sometimes there can be days where you look at that and you're like, we're just going to continue to charge forward. No matter what, we're not going to give up. We're just going to keep doing it. And, every day is an awesome experience, talking to guys like you, talking to people all across the country, getting to travel. And, there's days where you're like, all right, just got to put one foot in front of the other. We're not going to give up. So
all right. I think you dodged my question. The image that came to my mind was the little train that could.
That works.
All right. So I'm going to leave it there. Beth, I'm going to throw that at you. We have a world of everything from Simpsons to a variety of cartoon characters. Which cartoon character in your life that you've seen best exemplifies who you are?
Well, I was hoping you wouldn't come back to me with that. Cartoon character that best exemplifies who I am. I don't,
It's hard. We don't know cartoons.
I know. I mean, who's the coyote that always had the anvil drop on his head?
Wile E. Coyote?
I'm not the coyote, but at the same time, the guy just didn't give up.
He was always after that Roadrunner.
Yeah. So I don't want the anvil dropping on my head, but I'm not going to give up either. So
right on. Well, folks, that's a wrap. Don't forget to like, subscribe, and stay tuned for more raw, real talk in the sandbox. Thanks so much for joining me today on the podcast. It's been great having both of you on. I know you're busy, so I am super grateful that you both taken the time to join me. All right. So have a great day. I think my producer